Welcome to the Skillick Explains video, and welcome to a slightly technical one but an important one, and that is why traded options are best left to the professionals. Now, why am I saying that? The answer is that traded options have become super popular in the retail market in certain countries. India springs to mind, for example. And I think the reason is they're perceived as simple when the reality is they're actually quite complicated and quite risky, which is why I'm going to suggest that even if you can get access to them, you hesitate before diving in. All right. Now, for those people thinking traded options, this sounds a bit complicated. What is an option? Options are actually incredibly simple sounding. I'll give you an example. A friend of mine called Bob, right, this is based on a real life example, is currently in the process of trying to buy a property on the island of Mallorca. Right now, the way the property market works there is if you want to buy a property, say a year from now, you can't just say, well, I'll wander back in a year and see how it's going, whether it's been sold. You put a deposit down. It's a binding deposit. So you put a 10% deposit down. The mechanics are this, basically. If you follow through and buy the property, could be up to a year from now, fine, that deposit goes towards the amount you eventually pay the seller. If, on the other hand, you change your mind, say, actually, don't want that house anymore, you lose the deposit. So the deposit gives you an option on buying the property. And you might say, well, why wouldn't you buy the property? Well, imagine for a moment the property plunges in price in the next 12 months. Would you exercise an option to buy it at last year's price? Probably not. You might sacrifice your deposit so that you can buy it a lot cheaper. There's a trade-off there if you think about it. Whereas, of course, if property prices rise, it's useful potentially to lock in a 10% deposit for a price agreed now that will still apply in a year's time. So you probably get the idea. Now imagine you could extend that principle to something like shares, a basket of shares, or an index like the FTSE 100 or the S&P 500. Well, here we go. This is where buying and selling options, traded options, comes in. All right. So what's the basic deal? If you can extend the principle to other assets, to the financial markets, how does it work? Well, an option basically gives you the right to buy. It's called a call, or sell, called a put. Literally call it an asset or put it away, if you like, over a certain period. So like my house example, it expires, right? You don't have an indefinite amount of time to decide whether you want to buy a particular share or a group of shares or an index. You might have 3 months, for argument's sake. For that option, all right, for that right to decide whether you want to buy shares at a pre-agreed price in 3 months' time, you pay a non-refundable premium. I mean, why would anyone give you that right for nothing, if you see what I mean? Because then they're taking all the risk. So you pay a non-refundable premium, a proportion of the overall value of the trade, all right, and essentially the deal's the same. If you don't exercise the option, so you say, I'm not buying those shares anymore, change my mind, price has moved, you lose the premium, 100% of it. But if you choose to exercise the option and buy the shares at a pre-agreed price, because presumably they've gone up, so you could kind of got an instant profit, if you like, then fine, you will recover your premium in terms of the overall profit that you make at the end. And traded options are hugely liquid. The advantage of a traded option, unlike my friend Bob's option, which is private between him and the seller of the house, is that what you can do is buy an option, pay a premium, a proportion of the value of the underlying shares, and then if the underlying shares rise in value, you can sell the option on. Actually, you don't have to use it. You can just sell the right to buy those shares at a pre-agreed lower price on to somebody else, and they'll pay you because they're thinking if the share price keeps going up, oh, I want that option. That's useful to me. Okay, so some big advantages. This is why they're popular in India. Premiums tend to be only a proportion of the value of the underlying asset, a basket of shares or an index in this case, and you can only lose the premium if you don't exercise the option as the buyer. All right. Potentially, you've got a big upside. Because if you think about it, what you're doing is saying, I'll pay you a little bit now in order to lock in a price I can buy an asset, in this case shares, right? And you've got to deliver the shares at that price no matter what the market does in the meantime. Now, if you're thinking what mugs the other end of this trade, is someone thinking, yeah, I'll take your money, Tim, because your right to buy is going to be worthless in 3 months because the share price is going to plummet. All right, so why would you buy shares from me at a fixed price using an option when you could buy them in the open market cheaper? Fair question. Takes two to make a market. All right, so For the buyer, small premium, potentially lost if they don't exercise the option, and a big potential upside. In theory, unlimited potential upside, because share prices, like houses, could in theory keep rising indefinitely. However, if you're thinking, this sounds pretty exciting, all right, this gives me geared exposure, all right? Geared exposure means I pay a little bit now for a potentially big profit if things go my way. If you think that's a no-brainer, watch out, okay? Number one, these are actually more complicated than they look. That premium you're paying up front is based on something called implied volatility. Woo. Because if you think about it, what somebody's had to do is sit down and work out how volatile the share price might be over the next 3 months to set the price they're prepared to sell you the option at. A bit like buying car insurance. Your likelihood of crashing a car influences what you pay as an insurance premium. If you want to see it that way. So there's a complicated factor when it comes to pricing options, which a lot of people don't grasp. Took a Nobel Prize winner or two to come up with a formula. All right, you can lose 100% of your investment. People say, well, if I put money into a house deposit, my Bob example earlier, or money into an option, what's the worst that can happen? Well, you can lose it all if you don't exercise the option. And by the way, if it takes you more than 3 months to make your mind up, the option expires anyway, and you've lost the premium. And that could be 100% of what you've sunk into the contract. Okay, and there are no free lunches in financial markets. So if you're in the Indian retail market for traded options, you're thinking these things are brilliant. I just pay a little bit for the right to buy shares in the future at a pre-agreed price. Think about it for a moment. Somebody has priced that option before they sell it to you based on what they think is going to happen next. So it is a market, right? There's no free lunch. And in reality, an awful lot of options are never exercised. They're bought by people simply looking for an insurance policy, big institutional investors who never really intend to exercise the option. So my conclusion is I would personally, like the regulator tends to encourage here, leave it to the professionals. Options are not for everyone. I agree with the FCA's stance on that entirely. So even if you're tempted, even if you're reading the headlines about what people are doing in other countries, I would tend to leave them well alone unless and until you know a lot more about them. Okay, well, to find out a little bit more about them, you could go to my other videos, Killick.com/resources. You could take a look at my How to Invest in Equities guide. There's not loads in there, but there's a little bit. Or occasionally this pops up in our quarterly magazine, Confidant.